Hey everyone, welcome back to Corporate Dakota, the place where we unravel the secrets hidden within financial filings. Today we're diving deep into Newell Brands' latest quarterly report, and let me tell you, there's a lot to unpack in their June 2025 filing. Think less brand sparkle, more behind the scenes financial maneuvers. If you like getting the real scoop on what companies are up to financially, make sure you subscribe and join our Discord community, linked in the description below. It's the place to be for us finance nerds. Alright, so Newell Brands, that name you probably recognize from household names like Rubbermaid Sharpie and Yankee Candle. They've just released their financial report for the 3 and 6 months ending June 30, 2025. Now we're going to cut through the jargon, focus on the numbers that matter, and see what's really going on with this consumer goods giant. Let's start with the top line net sales. For the 3 months ending June 30th, sales were down about 5% compared to the same time last year. That's a drop of almost $100 million. Now they say this is due to soft demand and retailers managing their inventory, but a 5% dip is still a significant chunk. Globally, across all their businesses, things are a bit sluggish. They did mention some good news with new product launches and pricing adjustments, especially to counter new tariffs, which helped a bit, but not enough to offset the overall decline. Moving down to gross profit, which is what's left after they pay for the stuff they sell. That also dipped by about 2%. However, their gross margin, which is that profit as a percentage of sales, actually improved. It went from 34.4% this year. This is a good sign, showing they're getting better at controlling their costs relative to what they're selling. They attribute this to productivity gains and, yes, lower restructuring costs, which we'll get to. Now for operating income, that's the profit from their main business operations before interest and taxes. This actually went up slightly by about 5%. This rise is thanks to those cost savings from restructuring and, frankly, lower restructuring costs themselves. So while sales are down, they're managing to squeeze out a bit more profit from the operations that are still running efficiently. Here's a big one. They took a loss of $13 million related to paying off some of their debt early. This happened in June when they bought back their 4.2% notes due in 2026. They used money from selling new 8.5% notes due in 2028 to do this. This is a common move to refinance debt, but it always comes with a cost in the short term. The company also paid more in taxes this quarter compared to last year. Their tax rate was higher at 35.2% compared to 46.4% last year, which sounds a bit confusing, but it's because last year had some special tax benefits that they didn't have this year. So even though their pre-tax income was lower, their tax bill as a percentage was still higher. All of this led to a net income of $46 million for the quarter, up just $1 million from last year. Given the revenue drop and the debt situation, this is a pretty flat performance. It means they're barely making more profit now than they were a year ago, despite all the moves they're making. Let's zoom out and look at the 6-month period ending June 30th. Net sales are down about 5%, again similar to the quarterly trend. This is a decrease of nearly $185 million year over year. Gross profit is also down slightly by about 1.2%. But again, the gross margin improved from 32 up to rebound 9%, which is a positive sign of internal efficiency. Operating income for the 6 months is up a bit more encouragingly at over 7%. This is driven by those same factors we saw in the quarter: lower restructuring costs and savings from those efficiency plans. This is where it gets interesting. Last year, they benefited from a tax credit of about $12 million. This year, they had to pay about $7 million in taxes. So that swing of almost $20 million is a big reason why their net income looks so different. And that brings us to net income for the 6 months. It's down significantly from $36 million last year to just $9 million this year. That's a 75% drop. A lot of this is due to that tax benefit they lost from last year and increased debt-related costs. Now let's look at the balance sheet to get a feel for their financial health. Accounts receivable are up quite a bit from $878 million at the end of last year to over $1 billion now. This means customers owe them more money. While some of this is expected with sales patterns, it also means they're waiting longer to get paid, which can tie up cash. Inventories are also up from 1.4 billion to 1.5 billion. This could mean they're stocking up for future sales, or it could be a sign that some products aren't moving as quickly as they'd like. Given the soft demand trends mentioned earlier, this is something to watch. Goodwill is a big number on their balance sheet at over $3 billion. This represents the premium they paid for companies they acquired over the years. The good news is it increased slightly, which suggests they haven't taken any major write-downs on past acquisitions, which is a positive sign. Their total liabilities have also gone up They're now at almost $8.8 billion, up from $8.25 billion at the end of last year. A big chunk of this is their long-term debt, which is around $4.5 billion. Looking at stockholders' equity, you see their common stock and additional paid-in capital, which are the owner's stake in the company. That amount is pretty stable. However, their retained deficit, which has accumulated losses over time, is a large negative number, almost $3 billion. This indicates that over their history, they've accumulated more losses than profits. Their total stockholders' equity is just under $2.7 billion. This equity position relative to their debts gives us a sense of their financial cushion. Now let's talk about cash flow. This is super important because it's the actual cash the company is generating or spending. For the first 6 months of 2025, they used $2071 million in operations. Typically, companies want to see positive cash flow from operations. This huge negative number is concerning, and they mostly blame it on increased working capital needs like those accounts receivable and inventory changes we saw. Investing activities, which include things like buying new equipment or buildings, also used more cash this year. They spent $92 million compared to $84 million last year. Financing activities, which involve borrowing money or paying it back, show a big jump in cash coming in. They brought in $382 million this year compared to $78 million last year. This is mostly due to using their credit revolver more. Overall, their cash position only increased by $23 million for the 6 months ending June 30th. This is down from an increase of $44 million in the same period last year, despite the big inflow from financing activities. The negative operating cash flow is a major red flag. Let's touch on restructuring. They've been undergoing a realignment plan and have racked up restructuring costs. For the first 6 months of this year, they spent $37 million on restructuring and related costs. Last year, it was $65 million, so they are spending less, but it's still a significant expense as they try to streamline operations. Now let's look at some of the challenges they mention. They're involved in a lot of legal and environmental matters. The big one is the Lower Passaic River matter, where they're identified as a potentially responsible party. They settled some parts of this for over $1 billion total across many companies, but there's still ongoing litigation. While they don't expect this to be material right now, they acknowledge that an adverse outcome could be. That's a classic, we hope for the best but prepare for the worst situation. Tariffs are also a big concern. They anticipate about $155 million in cash tariff costs for this year before any mitigation. They are trying to offset this with pricing and moving production, but they admit it's hard to predict the full impact. Adding to their worries, both Moody's and S&P downgraded their debt rating. This means they're seen as a riskier borrower and they'll likely have to pay more interest on some of their debt going forward. They estimate this will cost them around $5 million more in interest annually. They use derivatives to manage financial risks like currency or interest rate fluctuations. They have significant cross-currency swaps worth hundreds of millions of dollars. These are complex financial tools, and while they are meant to manage risk, they also introduce their own set of complexities and potential for losses if not managed perfectly. Interestingly, they bought back a small amount of their own stock. About 810 AD10s, the stock is undervalued. However, with the overall financial picture, these repurchases are pretty small in the grand scheme of things. So what's the story here? Newell Brands is navigating a tough economic environment. Sales are down across the board and they're burning through cash from operations. They're trying to manage these challenges by cutting costs, restructuring, and adjusting their debt. The improved gross margins and operating income in some areas show that their strategies to become more efficient are starting to work, but it's not enough to overcome the headwinds yet. The big negative operating cash flow is the most pressing concern right now. They're relying heavily on borrowing to keep things afloat, and the recent debt downgrades add another layer of risk. They believe their turnaround plan is starting to show results, but the numbers in this report suggest they still have a long road ahead to achieve consistent profitable growth. The market is clearly watching closely, as evidenced by those credit rating downgrades, add another layer of risk. They believe their turnaround plan is starting to show results, but the numbers in this report suggest they still have a long road ahead to achieve consistent profitable growth. The market is clearly watching closely, as evidenced by those credit rating downgrades, add another layer of risk. Alright, that's our deep dive into Newell Brands July 2025 filing. If you found this breakdown helpful, give this video a thumbs up and let us know in the comments what you think about their performance and their future. Don't forget to subscribe for more corporate dissections and join our Discord for more engaging discussions. Thanks for watching and we'll see you in the next video.